Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
And besides AA getting married, the market sure created some waves.
Yeah, it was a pretty fun week, wasn't it?
Congratulations on your betrothal.
Oh, thank you, Mike. Glad you were there.
Went to Denver and watched AA marry somebody he's been with since high school.
Not quite that long, but pretty close. Yeah.
Anyway, it's always good. And while we were enjoying the bliss of a beautiful Colorado wedding, the market took a dump and then recovered. And in my most recent article that I just sent out to subscribers at stockcheatsheets.substack.com, kind of made the football analogy. So for those of you who receive the newsletter or would like to receive it by subscribing for free, you will get a sense of kind of how to interpret the data charts today as we kind of go through global US equities, bonds, commodities, even a few currency ETFs to try to predict intermediate market direction and get a gauge on whether or not it's safe to try to follow the trend right now. And so without further ado, why don't we dive right into the content?
Okay.
And I'm pressing some new buttons here, so don't mind me. I think I just have to press this one button right there. That's what that button does. All right, so AA, I kind of made a analogy to football, and our 10-factor pre-trade checklist is basically an amalgamation of a bunch of technical metrics that are weighted proprietarily to come up with a score. If you're not really into the micro analysis, green is good, red is bad. And otherwise, there's some other factors here. Combination of lagging, current, and leading indicators. First thing that's worth pointing out, for most global stocks that matter in the big economies, the long-term trend of the markets, factor one, is still up. That's the 10 over the 40-week moving average. So right now, this is nothing more than, at worst, an intermediate pullback. Now, the stocks did kind of finish higher than they started the week, didn't they?
Yeah, they sure did.
So we're going to go over what the implication is.
Yeah, not by much, I should add, but yes, it's almost as if the week didn't happen.
Yep. And if you only have 2 minutes, notice that this is a collection of all the ETFs that symbolize most of the major global stock indices. Some of them are regional stock indexes. Some of them are individual countries. But other than India, and including long duration treasuries, we are bearish. Now, I know you're bullish, and we're going to get to this in more detail, but let's go over why you're bullish on interest rates in the intermediate and long-term end of the U.S. Treasury curve.
Yeah, I mean, and to be specific, just the long end of the curve.
Yep.
I think, as you mentioned. Yeah,
and with the TLT at the 20-year note qualify, or is that?
Yeah, absolutely. Yeah, I think that the TLT is probably a little overcooked in my opinion.
Yeah.
And like I said, I'll make it as quick as possible. There was a pretty severe knee-jerk reaction to a jobs report that, sure, the job market is slowing, it's softening, but it's also not collapsing. And that's kind of what the reaction was.
Yep.
So I think there'll be some reversion there. Also, we can talk about it more in detail if you'd like, but this yen carry trade, which I'm sure everybody's heard at least a little bit about.
So that's when you borrow yen, which is really cheap right now because the Japanese central bank has been basically printing money since the 80s.
Right.
Borrow yen and then you buy dollar denominated assets.
Or you do things like short treasuries, right? Because that's another way to express, dollar strength.
Yep.
Right. So when that unwinds, if you're short treasuries, you have to go buy treasuries and, could just be a covering rally there, at least in part. It's never one thing.
So that's why it's called a carry trade.
Yeah. So I think a lot of these things propelled bonds to a level that they probably got quite a bit ahead of themselves.
Yep.
And also because of that, I think it opens the door a little bit for Treasury to maybe shift how they're issuing new debt to maybe cover some more of the long end because they've been issuing very heavy on the front end. So it's kind of a long story, but that's kind of it in a nutshell.
But the Japan is sort of a sneak preview of coming attractions for the U.S. because Japan's debt to GDP ratio is about 240% right now.
Yeah.
And I think we're about half of that, right? We're about $1.20, something like that.
Yeah, and really to underscore the point, did you know the Nikkei, their major indice there, closed last week still at a level lower than it did in 1989?
That's right. And it had its worst single day performance earlier last week.
Yeah.
That was akin to a 1987 crash. I think they were down, what, 12 or 13% on the day.
Yeah. So they've lost decades there.
Yeah. Now, of course, the Japanese people actually get along with each other, unlike here in the United States.
Right.
And so hardship is a collective endurance. And a lot of experts think that Japan has a lot more room to absorb this irresponsible fiat currency money printing, which is at the heart of all this. So Japan has been basically printing money. And in real terms, the Japanese society has gotten progressively poorer in dollar terms over the last 40 years, 50 years, ever since the peak of the Japanese business boom in the late 80s.
Yeah.
And so what we've learned is printing your way out of debt and because Japanese have really gone overboard, the central bank buys everything in sight to avoid a depression, essentially.
And Japan's been moving counter to other world central banks for a long time. They've just embarked on a tightening cycle when everybody else is about to ease.
Yep. And because they never and they never tightened when everyone else was experiencing inflation.
Yeah.
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 And of course, Japan is a net energy importer, and they've got a big population problem. Korea, Japan, Germany, Russia and China are four countries that basically have no working age youth to replace retirees and the oldest populations. So the U.S. is in a little bit better shape. So again, in many ways, Japan is just a preview of coming attractions for us, where as our population continues to gray, as our debt gets out of control, what is it? $11 trillion in new bonds likely to be issued at least next year.
Yeah, and that's just another reason why I'm long interest rates.
Yep. And so you're kind of defying the conventional wisdom, and you, of course, you're a mortgage broker, but you advise clients, and your big specialty is timing loan locks.
Yeah, I don't maybe not even timing, but just understanding,
optimizing, maybe.
Optimizing maybe a better word, and just understanding how this market works, because there's not a lot of folks in the field that really understand this. And yeah, I am definitely counter trend to the rest of the industry. They think that
rates are coming down.
Rates are going to come down, and it's going to be a refi boom, and all these things are coming. And I'm not convinced. Matter of fact, I'm leaning the other way in my positioning.
And what about your phone in terms of inquiries about new loans? Is it still at rock bottom, or has it improved slightly compared to when rates were going much higher and housing affordability was a big issue?
No, it's actually, personally, I mean, a sample size of one, my phone is ringing less now than it did last fall when rates were even higher.
Well, of course, rate tightening is very much a lagging indicator. Yeah. A lot of folks think that when you start raising rates as precipitously as we did, 18 to 24 months later is when things start to manifest. And actually, stocks usually correct first before the housing market. The housing market is kind of the last thing to have the bottom drop out of it.
Yeah, and it's held up. So still to come, I guess, maybe.
All right. So the summary for this first chart. Basically, green is good, and actually anything that's optimally bullish is going to be 60 to 85%. That's our optimal tailwind score, and that's a composite of these 10 factors. The first 3 factors are trend, long, intermediate, and short-term trend factors 1 through 3. 4 is a really important metric. That's buying pressure. So the more red you see, the more that particular index ETF is under distribution. Buying pressure, we use Chaikin money flow. Basically, a very bearish score is Chaikin money flow minus negative 0.2, just regular old bearish, negative bearish. Negative money flow would be minus 0.1. And then neutral is going to be between 0.1 and negative 0.1. And then bullish will be, stages up that look the reverse of the bearish metrics. Relative strength on the 3 and 6 month basis are less important when determining market direction, more important in terms of where the bearishness or the bullishness is more likely to unfold. The weaker the relative strength, the more likely that index ETF has already or will plummet. And then we get into the 4 leading indicators, which are actually one indicator broken up into 4 parts of the market forecast. The ones we're going to pay attention to today are factors 7 and 8, the long-term forecast and the intermediate term forecast. The intermediate term forecast is really important to us. That's factor 8. That's our weeks to months trading time frame. Cheat Sheets is optimized not for investors, okay? And that's really important. This is the money that you can round trip to make some gains over the course of a year at most, and more likely a few months. And whenever we see the intermediate market forecast at neutral plus, it means we're slightly bullish. But there's a caveat to that, which we'll get to in a second. But what we really like to see is the long-term forecast and the intermediate term forecast, so factors 7 and 8, in agreement, both at least light green, preferably darker green. So when you have one that's weekly bullish, which is the junior of the 2 longer term timeframes, the weeks to months timeframe is neutral plus, so slightly bullish. But you can see for the most part, with the exception of gold and treasuries, long-term treasuries, everything else is bearish, slightly bearish to very bearish. And so think of that like in my football metaphor. If you're on offense, which you would be if you got a neutral plus intermediate market forecast or better, it's like having the wind blowing hard in your face, harder to move downfield. Usually the defending team can make adjustments because they know it's going to be harder for you to pass the ball to receivers. So they're going to put more personnel on the line to stuff the running back and put pressure on the quarterback. And so that's sort of the first thing we look at. So even though the intermediate trend itself is up, the long-term trend forecast is actually bearish. And in some cases, like with the Qs, very bearish. And that just simply is an extrapolation of momentum. All right. Okay. Does that make sense, Double A?
It does.
Yeah. And which can you see better, since you're able to see this, when I just scroll like this or when I actually blow this chart up?
Yeah. So, I mean, this is a larger image, so easier to see, but I just can't see the whole thing. So you do have to scroll. So it's however you want to present it.
So this is easier to see.
Yeah. It's a little bit bigger font.
Okay. Compared to that.
A little smaller, but I can see the entire image.
Okay. Very good. All right. I'll keep it to the screen here. Okay. All right. So let's take a second here. And here is the SPY. And this is a long-term weekly chart. You can see I've drawn a trend line. And I think this is illustrative of 2 different types of market conditions. The one on the far left, that is what I'd call a bear market. It was not a really devastating bear market, but you remember 2022, right? Markets went down for most of the year.
Yeah. So
we made a series on a weekly basis of 3 lower lows and 3 lower highs before beginning to reverse. And so that's that would be right there, a protracted bear market where things are going to go down in the long term. So the long-term market forecast, when it starts to get very bearish, it's more likely we'd have that kind of scenario unfold. We're not there yet for the most part. I would argue that so far anyway, the pullback isn't even as severe as the one we had a year ago. Remember late last summer through October-ish, before the current rally took off, we had a good, 3 to 4 week downturn, or maybe a little longer. Actually, it was more like 12 weeks. Lasted basically this late summer and early fall.
Yeah.
And so that's what you see just above the month of October. And then we had a minor 4-weekish pullback in the spring. And so far we've done that again here in July, as we're trying to figure out Fed rate cuts and economic data. And the market went through a series of pretty volatile weeks, but then we hit our feet on the floor. That's the 40-day exponential moving average, that one in red, which is sort of our proxy for I guess the one that institutions pay more attention to. It's slightly more slow moving is the 200-day moving average. This would be the closest thing we've got to that. A little bit little bit more of a leading indicator than the 200 day.
Yeah. Okay.
And you can see that, what do we call that? A piercing line?
At the 40?
Yeah.
Or at the 200 rather?
Yeah, at the 40-week
40.
exponential moving average.
Yeah. Yeah.
Yeah, it's the opposite of a dark cloud cover when you start low and then you gradually build up. So it's like you're piercing into that downtrend. And that's actually a bullish reversal candle.
It is.
Yep. And with decent volume in both the plunge and the recovery.
Mm-hmm.
And so the expectation would be that maybe we'll rally here a little bit. We'll see, right?
Yeah, I'd add, and you can't see it on this chart, but also, having rallied for basically the entirety of 2024, this last few weeks has blown off a lot of the overbought conditions.
That's right.
So, a rally isn't a little rally here isn't going to be crazy. Yeah.
But I think based on and now I'm going to move to the indexes here. And what we're looking at now are just basically U.S. indexes, and I threw a gold and a treasury and a dollar. UUP is the dollar, just to sort of compare everything. So major stock indexes is the most, the greatest part of this. Tell me if this looks bigger to you when I do it like this.
Yes.
Okay, so we'll use this. So first, there's nothing bullish here. And only gold and treasury are in a long-term uptrend, even though you can't see it because I've cut off factor one on this chart.
Do you find that interesting that gold and treasuries are moving in tandem?
I do.
I do too.
Although I do see that the dollar is weak and gold is relatively strong anyway, even though it's not bullish. And by the way, when I said we're actually in an uptrend long-term on all the equities, the factor one is bullish pretty much across the board, but intermediate trend, it's only gold and treasuries.
Yeah. I find that interesting. Okay.
Yep. And then you have SPY. So basically anything below 40% tailwind score means the combination of both leading, present day, and lagging indicators suggest the sum total of the evidence is, unless things change and there's a lot of momentum in the next few days, this rally, I think we both concede that a rally is likely.
Yeah.
But it's prone to failure. And institutions will be looking for a key resistance level, whether it's a moving average or a previous high, for example. They'll be looking to sell that, barring some kind of new catalyst, right? That hasn't been priced in. And I think you had mentioned to me something that I'm starting to think about, is I'm not convinced the Federal Reserve is ready to do any kind of emergency rate cut, let alone a 50 basis point rate cut in September.
I mean, think about the political. I know they're not political, but they're also political, right?
Right.
So think about the implications.
Especially because he's a Republican Fed chair.
Yeah. Nominated by Trump, as a matter of fact.
That's right.
Think of the implications of a 50 basis point rate cut at the meeting before a hugely contentious presidential election.
Yep. And the Fed's not in the business of saving the stock market, or at least they pretend they're not.
They pretend not. Yeah, that's right. Yeah. So I
think that there's a chance that Jerome Powell does what he did a year ago, which is to throw some hot water on the market to try to, because right now, actually, if you look at the Fed fund futures, actually the probabilities for the pay to play market are greater for a 50 basis point cut. At least they were going into the start of trading on Friday. I don't know how they ended up.
About the same. I don't know exactly where they ended, but it wasn't a big change. And don't forget, though, Powell.
So what we're saying is, just so I finish the thought, 50 basis points, the probabilities were higher than for only a 25 basis point cut.
Yeah, but don't forget, Powell has his Jackson Hole. It's either this week or next week.
Exactly right. The speech.
Right, where that's where he takes that opportunity to
cold water
tweak policy. That's right, and that's another reason why I think that bonds have gotten way ahead of themselves.
Now, I didn't do my homework on what data is upcoming. I did a lot of homework on data that we've had in the last week or two that's influencing the market. And we've certainly gotten some slowdown data, but I think the unemployment print we got in the later part of the prior week was ameliorated slightly by the fact that the unemployment claims were a little bit less than what people were expecting. Yeah. So there might not be as much panic in the Fed for an economic slowdown as there is on Wall Street for avoiding any kind of recession.
Yeah, I agree with that. And just a big piece is coming this week with July CPI.
That's right. Yep. And that'll be a big one. And we expect that inflation will continue to moderate, but it's still nowhere near the 3% or the 2% target.
Yeah, the expectation, the consensus expectation is
Yep.
for it to be 0.02 for the month.
And as we record this at around 4 o'clock Eastern on Sunday afternoon, we're still sitting around and expecting Iran to do something dramatic.
Yeah.
And that could include blockading the Straits of Hormuz, which would send oil prices through the roof. So there's just, we're sitting on a strand, Ukraine invading Russia and, potentially within striking distance of more of their refineries and their nuclear power plant. It's going to be a wild week.
Yeah.
All right. So that's the domestic market. Basically, gold and treasuries are bearish, but gold is the least bearish. It would be neutral minus above 40. With very bullish near-term momentum and very bullish relative strength and mildly bullish buying pressure. And SPY actually now has some mildly bullish buying pressure. You're going to see what sectors are driving that.
And I said gold is in a very well-defined uptrend.
Yep.
Technically.
So the market is, and gold, of course, usually at the beginning of a rate cut cycle, gold and silver actually go down. But then once the Fed gets into that cutting, and the recession is upon us, usually the combination of the feeling of Armageddon and the devaluation of the dollar through money printing, gold and silver toward the back half of the rate cutting cycle tend to do really well.
Yeah, silver hasn't been keeping up with gold. Hasn't been doing a good job.
It hasn't. I did watch some trader on a Canadian YouTube channel that I follow that's clearly talking his book. He's in the mining business, but believes that, or shared that 70% of all silver mining capacity or silver production capacity is spoken for by industrial demand at the moment. Now, of course, price is not moving.
Right.
But this person, who could very clearly be talking in their book, claims that by the end of 2025, 100% 100% of the production output will be spoken for by industry because of the need for increasingly complex and powerful AI chips, because they take just a lot more processing power than the average computer chip. And so the demand story on silver, which is basically unlike gold, there's an industrial metal and a inflation hedge kind of use case for that metal, whereas gold is all about the inflation hedge, right?
Yeah. Or store value, yeah,
with BRICS countries buying it up. So it'll be interesting to see. But right now, dollar is looking much weaker than gold, and I probably should have Bitcoin in here now that there's Bitcoin ETFs.
Yeah, that had a wild week, by the way, too.
It did. Yep. All right. So here it is again. When you're under 30%, that's when you're most bearish, which a lot of parts of the market are in that way. But it's also can mean, and you saw that piercing line bouncing off the 40 period moving average, that there will be probably a need for another catalyst in order to get below that 40 week moving average. But when we're below 30%, now we can stay there for a long time, and the market can go down a lot. But in general, provided support holds, that's generally can be an inflection point. We're closer to exhaustion than not, barring some break. And so that's why we think there's probably a decent chance for a rally that won't be very long lasting, but a chance to perhaps shorten the time horizon and trade the strongest stuff.
Yeah, maybe think about repositioning if you get the chance.
So if you go to stockcheatsheets.com or stockcheatsheets.substack.com, either will get you there. Subscribe to my newsletter. This is where I do the football analogy. And I'll break it down here using our sector ETFs. And there's real estate, which again, the market is discounting Fed rate reduction, and they're expecting your phone to ring for new mortgages, AA.
Yeah.
So that's the one bullish sector. And then the stuff that's working next best, although bearish though it may be, is utilities, staples, and healthcare. We generally see those at the top of the market whenever the market is chasing yield and trying to be defensive.
Yeah. Utilities actually came off its high a little bit this last week.
It did. It was pretty overbought.
Yeah.
As were all of these defensive names.
Sure.
So, and none of these are a home run either. These are also mildly bearish. The trends are great on all of these defensive assets: treasuries, healthcare, consumer staples, XLP, XLU, utilities, and real estate. Very typical at the beginning of a rate cutting cycle to see that. And the stuff that does the worst, I don't even have it on here. It was so low. It didn't make, oh, there it is. XLE, energy, tech, consumer discretionary, XLY, and basic materials at the very bottom. So usually at the beginning of a recession, the market will hint that it's coming by discounting the things that typically drive a bull market.
The market sure puked up the IWM pretty fast, didn't it?
It did. There was no money flow. We'd warned about that.
Yeah. After that rally several weeks ago.
Yep. And by money flow, we mean, and actually, that's not any bigger. We mean buying pressure here.
Yeah.
So if you look at buying pressure, and I'll get into my metaphor. So the first thing is, the fact is that the trends are currently bullish for the most part on the defensive names and bearish. The intermediate trend is bearish on the cyclical or the kind of stuff when the economy is roaring. That's all bearish. So we're gonna take the bear case here. But when we see market forecasts, because we've had a little bit of momentum lately, when we go to factor 8, we'll notice that with the exception of the defensive names, which turned mildly bearish recently, and again, I think AA described it as clearing overbought conditions, we see slightly bullish intermediate term market forecast. So a bearish intermediate, factor 2, bearish intermediate actual trend, but a slightly bullish intermediate market forecast. And this is where I talk about a team taking over on offense, but pinned near their goal line. When we talk about buying pressure, you'll notice it's mostly red as you look at these, with the exception of the defensive names that we mentioned at the beginning, which are only mildly bearish, or what we call neutral minus. But everything else is solidly bearish or very bearish. So that's like being pinned in your own end with an offensive line that gives your quarterback no time to do anything, and is getting overwhelmed by a defensive line that's also plugging holes, so the running back can't get through. So it's very hard to advance the ball. And finally, to add to this kind of case of mild bullishness for the markets, you then have the factor 7, which is the long-term market forecast, again, with the exception of the defensive names. And for the most part, there's a slight bullishness still with energy and industrials, but everything else is pretty bearish. And that's like having the wind blowing in your face or crowd noise. So other sorts of things that keep you from being able to move the ball. So yes, we're bullish, ever so slightly bullish, but the reason the tailwind score is so horribly bearish is because of all these other factors that make the risk of going 4 and out, or worse yet, turning the ball over deep in your own territory, or a quarterback under pressure throwing a pick 6 and giving up points. That's how we would describe the market conditions right now. Make sense?
Yeah, sure does.
All right. And then subsectors, again, just continuing the theme of what's working. Well, it's going to be the stuff that gives a dividend and that's less dependent on growth infinitum, ad infinitum. So pharma actually looks pretty good. And REITs, RWR, XPH is pharma. And of course, there's more liquid versions of this. We just choose to use this particular set of ETFs because they're all from one fund family, the S&P 500. So we can compare them to the SPY. So here you've got the SPY in this snapshot at 29, very bearish, under 30. And you've got telecom at 91, so very bullish, and real estate optimally bullish, and pharma neutral plus. Other than that, and software and services looks interesting. It's almost recovered. Notice the very bullish buying pressure and the multiple leading indicator bullishness, meaning factors 7 through 9. So yeah. Software and services is something I'm going to look at tomorrow for premium subscribers, and that's going to be an area of interest for our premium stock picks.
Yeah, I like that. I'd like to see that too.
Okay, and then, if you want to understand these 10 factors at a greater level, this is kind of a cheat sheet of cheat sheets, how each of the 10 factors kind of impact the tailwind score. All right, so let's spend a little bit of time on this. We sort of alluded to these things, but here's what I think, now looking beyond just the possibility of a few days to a few week rally, possibly followed by more selling. let's get honest about the things that are going to make next year tough.
Okay.
So the unemployment rate, while there was some softening of jobless claims this week, it was just sort of one data point. The overall trend is it looks like companies are going to downsize and are downsizing. So we're what, about a 4.3?
We're at 4.3, but I want to mention this. So I have to tell you, Mike, I stole your term a few times this past week, and the term being pessimism porn.
Oh yes, pessimism porn. There's a lot of pessimism
There's
porn.
A lot of it everywhere, which really makes me stop to think about and
Yeah.
critically think about what's happening, right? Because
Yeah.
everybody's on the same side of the trade, which puts up the red flag for me.
And market participants always on the same side of the trade are always wrong.
That's right. And so everybody's talking about a 4.3 unemployment rate and talking about how the employment market is collapsing. I think it's important to point out that the 4.3 is not coming largely from job loss or layoffs. It's coming from people entering and re-entering the workforce, which that's a pretty important distinction, and could mean something completely, and does mean something completely different.
A lot of those people are picking up extra jobs because they can't afford to live in the country anymore.
Yeah, or it's because of immigration, right? And we have a hard time with the way our data is farmed. It's so out of date the way we do things with data that we're
a phone-based survey and nobody answers the phone anymore.
It's prehistoric, and so we're having a hard time picking up on immigration. But we do know that there's way these folks find jobs. They create LLCs and become self-employed. That's why there's been such a creation of businesses. It's because one guy from another country creates an LLC so he can work legally. It's a loophole. They take advantage of it. So I think that the doomsayers about employment may be a little bit ahead of themselves, and because there's so many of them, I really think they're ahead of themselves.
So the SOM rule, which I basically had never heard of until this year, may have been triggered by erroneous data points because it's got weekly moving average against the snapshot, and if the unemployment rate in the snapshot is 50 basis points lower than the 3-month moving average, then the SOM rule is triggered, and apparently that's predicted 100% of recession.
So I've been in online arguments with mortgage brokers about this SOM rule thing, and the author Claudia Somm recently has said it many times in the past several months, and as recently as Friday, is that her rule is broken. It doesn't apply because the rule was written for job loss, not new entrants into the workforce,
or antiquated measurement that no longer reflects how people share data.
Yeah. So the SOM rule, just make a paper basketball out of it and throw it out the window.
So the housing market is slowing, but I got news for you. The market is still in a lot of markets hitting all-time highs in terms of price. So we're not collapsing yet, but we've definitely slowed.
It's very regional too. So that's the other thing I hear is, there's never been a higher number of a percentage of people cutting their sale price. I'm like, well, that's in certain markets, right? Like your market, for example, Mike, I'm sure you've seen it locally. Austin is one of those markets where there's a lot of inventory and there are a lot of price cuts going on, but nationally, the market's still pretty solid nationally.
And my neighborhood near a good school district has actually rebounded probably about 10% in the last 12 months.
Nice.
So we lost 20%, gained back 10%. It's that typical, lower highs, lower lows sort of cyclicality. We're just seeing the beginning of a cooling period for housing that could lead to, if more people lose jobs, it's going to get ugly.
Yeah, I just don't see 2008 happening again. I think there's a put under the housing market, whether right, wrong, whatever. I just think that there's one there.
So credit card defaults and credit utilization, where people are putting more things on revolving credit because they can't afford to make ends meet. That's still largely the lower 2 quintiles on the economic spectrum. So the upper middle class, the high end, is still spending like drunken sailors for the most part.
Yeah.
But we don't, so we are seeing like an increase in, although auto loans due to falling auto demand is off, but the credit market the consumer credit market is not collapsing. Now credit spreads are widening a little bit.
Just a little.
And so just above junk level corporate debt, the difference between the bid and the ask price, which is what the market makers use to hedge their risk, that is widening just a little bit, suggesting that there could be trouble ahead, but it's very early. And it's certainly nothing to cause a panic yet.
Yeah. No, it's definitely a good point and something I'm watching also.
Yep. And then there's some other factors, but I think the thing I'd want to leave everyone with is I've done a little bit of research and drawn on my own experience. I've been trading since the late 90s. The fact is that people get all excited about Fed rate cuts.
Mm-hmm.
And I will tell you that once they begin, especially if they begin in earnest with a 50 basis point cut, which I'm skeptical about.
Same, very skeptical.
Markets generally go down. And when there's a bear market reaction to an impending recession, the prices go down pretty hard. So everyone clapping their hands loudly for a series of emergency rate cuts better be prepared for the stock market to go down 20%.
And if I could add on to that, I think a lot of people looking at the interest rate market think that when the Fed starts cutting rates, it's a precipitous decline in rates, but the decline comes before the first cut, right? The market prices in the first cut, and then largely it just moves sideways from there for some time.
Well, and again, what people who with savings account care about is the money market return and maybe the bank certificate of deposit or treasury bonds, and those basically start paying you nothing to save money. And then, of course, mid-cycle behavior, we start getting into stocks finding a bottom, usually well before a recession ends. And then stocks rally, usually before the recession ends and as the money printing begins. And the people that get burned usually by the hidden tax of inflation are the ones not in assets.
Right.
So this is where we look at stocks, commodities, and other sorts of cyclical, especially things that may not necessarily be tied to real growth, but funny money growth, government liquidity. When usually there's a fiscal and a monetary response to really tough times. And I've lived through this, really 3 times, because I think COVID was a mini version of this. It just happened so fast.
Yeah, I agree with that. It happened so fast and the reaction was so steep and so quick. Yeah.
But I don't think there's a whole lot of people in the prime of their career in the financial markets now, meaning people in their 30s and 40s or early 50s, that were around for the slow bear market that for as bad as the financial crisis was, I seem to remember that we got through it about 18 to 24 months. But I also remember from about March 2000 to nearly 2004, what a protracted bear market feels like. That's where people stop opening their 401k statements. And I don't think we have a lot of Wall Street professionals and investors or meme stock traders who've been through a real bear market before.
I agree with that.
And what rhymes with 2007 is the pundits' percentage chance of a recession, which we'll get to in a second. What we're looking at here, by the way, is this is the macro view. So the one thing I'll say is that typically when the markets or the economies are strong, demand for raw inputs are strong, commodities.
Right.
And the ETFs, the commodity ETFs hit their peak late last spring. Maybe it was even earlier than that. And they've gone nowhere for the most part. I mean, oil is maybe recovering now, but in general, inflation protected securities, treasuries, and while gold is bullish, it's not exploding. Obviously, the Japanese central bank is buying currency, trying to support the yen. So it's up there at about a 43. But in general, it's really hard to find commodities that are working. DBE is the kind of the hybrid, all the energy inputs from heating oil to natural gas and oil, silver, coffee, just nothing there. Agriculture, copper looks terrible, thanks to China and their real estate slowdown. Wood, agricultural, agribusiness, so big capital farming implements. Platinum that goes into catalytic converters and is used in a lot of the quote unquote renewable energy. Steel, natural gas, rare earth metals. This was a surprise to me to see how bad the whole commodity complex is, particularly the industrial side of things.
Yeah, I'm a little surprised to see a lot of this myself.
Especially given the amount of money the government is supposedly spending on through the CHIPS Act
Right.
and the Inflation Reduction Act.
Right.
But there it is. So finally, and again, this reminds me of the, so I am still mostly bearish in the long term, but in terms of the data, I'm probably bullish, but think that another hard correction happens before the election. Maybe not a really bad one, but and maybe not until next year. But I think that we're going to go through some hard times next year. But it might not be horrible. But I think it's going to be. I don't think the stock market is going to have a good time next year.
Do you think the highs of the year are in?
No,
Okay.
I think we might go back and retest the highs and potentially even go slightly above them.
Okay.
But if I were a betting person, I'd say we rally here after this correction and get back up to retest old highs.
Yeah.
What do you think?
I agree with that 100%. I completely agree with that.
Yeah. And it'll be based on the euphoria of Fed easing, and then the reality will kick in, and it'll all depend on the data. But data suggesting that we're going to get soft here at best, and potentially, quite awful as business slows down. We'll have to wait and see. But I think I'm going to watch the unemployment rate. CPI, I think certainly would be I would think now a secondary indicator, unless it starts going up again.
Yeah, I agree. And I think there's a non-zero, risk to that.
Yeah. Agreed. The geopolitical tensions and the reshoring and the fact that the market is going to anticipate, because I think no matter whether a Democrat or a Republican wins the White House, I think there's going to be stiff tariffs on the Chinese.
Yeah. Inflationary.
And which is inflationary. And then, of course, anytime you're rebuilding industrial plants and employing American workers to make widgets,
right,
we're going to not be paying, Walmart lower prices.
That's right.
Labor costs are much higher here than they are over in the Far East.
And it has to be passed on to somebody.
So finally, I do remember in the summer of 2007, Goldman Sachs, JP Morgan, BlackRock, well, BlackRock wasn't around necessarily, Citigroup, Morgan Stanley, and I especially remember Bear Stearns and Lehman Brothers all talking about 25%-ish chances of a recession in the summer of 2007.
Mm-hmm.
And then a year later, two of those banks weren't even around anymore.
Yeah.
So to sum it up, the consensus does not point to an imminent recession. I think AA and I are largely on board that it's the pessimism pornographers need clicks. And so the thumbnails on YouTube with fire and, economy burning is probably going to be much overblown. But next year could be a rough one. That's why we look at the data and follow the charts. So if you go to my Substack, you will see that basically as we give you updated data throughout the week, that we have what I like to call the climbing a wall of worry plan. So when is it safer to get back in? When you're an intermediate trend traders. Now, as an investor, I generally don't trade in and out of the market when I'm doing my long-term stuff. But, when I'm trying to ride a multi-week to potentially multi-month trend, I do want the wind at my back. And right now, too much wind blowing in my face. But these are the parameters that I look at when picking strong stocks and strong industry groups and strong sectors, and preferably when markets are rising with good buying pressure. So these are the things to look out for in the data tables. This is a good report to bookmark, because this climbing a wall of worry, which I don't publish every day, kind of tells you what to look for. And it's free.
Love it. I love it.
Premium stock picks out on Monday, and that's not free. But for $5 a month or $50 a year, we give you two premium kind of, we do a top-down analysis that starts with the indexes at the sector level, then the industry group level, and then the strongest fundamental, we rank the stocks based on fundamentals, and the top quintile then gets the tailwind treatment, and we include entry signals as well to make it really easy for you to then do your own research from there.
It's a lot of data for $5.
go to stockcheatsheets.com to learn more. And if you are in Colorado and in the market for a new home and need a mortgage, AA watches the rates so you don't have to. You're like scrubbing bubbles.
I love that analogy. Thanks.
Local Advantage Mortgage. And if you're outside the Colorado area, AA is well connected and can recommend a mortgage firm or broker in your state.
Yeah. And I also, on my Substack, it's macro2mortgage.substack.com.
That's right. So you can get that that bull steepening thesis in greater detail from AA every Monday.
Anybody interested in connecting those dots, that's where you can find me.
All right. So I guess we've been off camera this whole time, and at least for one of us, that's probably a good thing.
Both of us, actually, probably. Mike, it was great talk.
We will see you in a week or so for another edition of stockcheatsheets.com.
Thanks, Mike.